been working with him for a number of years, and he always gives us good insights into the markets. We're going to see what he has to tell us this morning. Rich?
All right, well, thank you, Danny, and thanks to everybody for coming out this morning. It is a lot more pleasurable to do this in person than it is online. I think last year most of us got way too used to and way too tired of doing Zoom meetings, so it's great to be back in person with everybody. And I honestly got to say that this is one of the most unusual years for doing grain marketing meetings that we've had, to say the least. This morning, big news overnight again that's impacting the markets. And what I find very wild about all of this is we're still, 45 days away from putting a crop in the ground, and the markets are going nuts. We got $6 December corn this morning. It's hard to explain. So we'll try to dig in and do the best we can. Before I get on the markets, since yesterday was President's Day, I did find this quote, which is kind of humbling to some of us who are not in the field every day, but farming looks mighty easy when your plow is a pencil and you're 1,000 miles from a cornfield. And again, I was born and raised on a farm, don't get there every day, and so it's kind of a good reminder, I guess, for a lot of people. But what's going on right now, inflation, I think, is still the #1 factor in the commodity markets. And when you look at commodity markets, I'm not just talking about the grains, I'm talking about oil, other markets as well. Commodities have had a heck of a run over the last year and a half, continue to be the case. South America got off to the best start they've ever had planting the crop this year, then hit a snag on weather. Southern Brazil, Argentina, Paraguay, all being impacted by drought. We'll look at that here in a minute. Mr. Putin, he's at the top of the list here this morning, I guess, with what's happening over the weekend, with supposedly sending some troops into these two states in the Ukraine. I did see this morning Germany, about 2 years too late, or about a year too late, decided to shut off the Nord Stream pipeline. So you can imagine energy prices are up pretty sharply here this morning. So we'll look at that here in a minute. We are seeing China a little slow buying this year. Their pace of buying beans has been less than what it's been in previous couple years. And that has been ignored for the most part, but it is a factor in the market. Energy prices at 8-year highs right now. We got fertilizer prices at record highs. I think that's probably the biggest story at the farm level this winter. But crop markets are at 11-year highs. And when you look at the prices right now, we are in the period of setting averages for crop insurance for this year through the end of the month. That'll be next Monday. And as of Friday night's close, we're averaging $5.86 a bushel on corn. That'll be the highest we've been since the 2011 year. And a whole lot better than we were through this period. Let me tell you, it wasn't a whole lot of fun. I imagine for everybody in the room, when we were sitting here in the 3s on corn, this time of the year trying to figure out how we're going to make money this year. What's the game plan? And we had to try to come up with those game plans. Today at 586, I think it's a whole lot easier, even with input costs being up this year. Soybeans, similar situation. We've got a record high bean price we're going to have. 14.26 average through Friday night. That's going to get up a few pennies above that as well. So our opportunities using crop insurance this year, using revenue insurance, is going to provide us the highest guarantees that most of you have ever had. Now, besides all the glitz and the glamour and all the other stuff going on, we do have a good fundamental story in the markets right now. If you look at world stocks to usage on all 3 major crops, corn, beans, and wheat, world stocks to usage is going to be down again this year. And so, again, despite all the other bells and whistles happening in the marketplace, we do have a good fundamental reason why these markets have been trending higher this year. But going back to 2021, it was a heck of a year for commodities. The green line on here represents the Goldman Sachs Commodity Index. And that index returned about 35% last year. It was a heck of a year for commodities. Now keep in mind, this index isn't just ag markets. It's not just grains, livestock. It's made up of a basket of commodities that includes energies, it includes precious metals, it includes soft commodities like cotton, lumber, sugar. Those are all in this basket. Crude oil tends to make up about 20%, give or take, of this basket. But you can see it was a good year for the commodity sector. We outperformed the S&P. We outperformed the World Equity Index. And so if you're an equity trader or an investor and you're trying to figure out how to make money and you thought you had a whale of a year in the stock market, and then you look and see what commodities did, you're like, huh. Well, you top that off with all this talk about inflation. Is anybody tired of the term transitory inflation? That was the buzzword, I think, the last half of last year. The government kept insisting that this is going to fix itself, it's going to fix itself. I think they've come to the realization that's not the case. And so as we started 2022, you've seen the stock market actually lose ground. And a lot of that money, traders are taking money out of the stock market, a lot of that's coming into the commodity sector. And so far this year, commodities have done very well, especially the energy markets, up over 20% year to date. Soybeans up about 17%. Cotton, hogs, corn, all posting gains so far this year. So it's been a good start for commodities, been a negative start for the stock market here in 2022. So I mentioned it, oil, kind of the big winner, or the big leader, I guess you should say, in the commodity sector. And if we all had it to do over again, we'd have been filling the fairgrounds with barrels of crude oil at the COVID low back here, $10 a barrel, right? Since then, we've had numerous things that have given this market a boost. Certainly the reopening of the U.S. economy was the big story, as well as the reopening of the world economy. Back in January a year ago, anybody remember what kickstarted the oil market? That was the signing of the shutdown of the Keystone Pipeline. That immediately gave the market a boost, and we continue to boost higher. We did see a setback in November. That was the Omicron variant. When that news hit the market, everybody said, uh-oh, and the government's going to shut things down again. That didn't happen. After about 3 days, oil started back higher again. Now we're trading what's the situation in Ukraine, certainly one of the big factors. Energy markets overnight strongly higher, made a new high, $96 a barrel here overnight. So I'm not sure where it's going. I've heard some people predicting 120 bucks, 110 bucks. I heard 150. Seems like the lowest guess is the wrong guess, maybe, but we'll see what happens here. But probably as long as Mr. Putin continues to rattle his sword, this market's probably got some potential upside. And the reason this is a big deal is you look at the correlation between oil and soybeans. Been pretty phenomenal over the last 10 plus years. This chart, I mean, other than the period in here in the late last decade where we were sitting on excessive bean inventories, we've seen a very, very strong correlation with soybeans and crude oil. So I would suggest everybody in the room keep one eye on the oil market. Certainly as the leader of that commodity index, it's potentially going to be the leader for soybeans and really for corn as well. And kind of seeing that here overnight also. Now, the managed funds, this is a snapshot of the fund position combined in the grain markets. This is corn, soybeans, soybean meal, soybean oil, and all 3 wheat contracts. So I just call this their grain position. These managed funds, the red line on the left-hand side, as of last Friday, they're long about 700,000 contracts, corn, beans, and wheat. Now, put that in perspective, the only time they've held more than that was a year ago. They were long about 800,000 contracts a year ago at this time. What happened from that point forward? Well, they held most of that in the spring until we got the crop off to a pretty good start. The crop at that point, coupled with maybe a reduction in Chinese buying, funds started selling, sold off at least half of that long position on into the summer months, which is typical for when we see crops looking good. People decide it's time to liquidate. They were still long about 300,000 contracts in the fall window. I think 2 things drove them back into the market. Number one was the rally in fertilizer prices. I think when that happened, these people were pretty smart. They recognized that higher fertilizer means corn needs to go up to try to keep acreage. And so they started buying corn. The next big leg of this was soybeans, the drought in South America, and that's taken them to a net long position of about 700,000 contracts. I don't see these people wanting to get out anytime real soon. I think that there's reasons why they view grains as a good investment, but I also recognize what happened last year. You know, you go into that spring window, and if we get the crop planted on time, if things start looking good, certainly we could see these people liquidate some of their land. So to me, the biggest risk that we've got in ag in the next 45 to 60, 90 days probably isn't weather. We're all sitting in this room right now, our seed's all in the bag. It's these funds right here. What do they decide to do? And so kind of keep that in mind. We'll continue to update what they're doing in the markets as well. Now, one last thing before I move into the grains is the consumer price index and inflation. A lot of this has been driven by inflation, and you see the consumer price index in December was at 6.8%, up from last year. January, we were 7.2% above a year ago. Pretty big deal. February is going to be up as well. And the impact of that is now the government's starting to scratch their heads saying, what are we going to do to fix this? And probably a little too late, right? The cow's out of the barn already. But they're likely to start raising interest rates. That's going to be the fix. Starting in March, we're expecting interest rate increases monthly. Goldman Sachs is saying 7 straight is what they're predicting starting in March. I've seen some folks talking about a half-point bump in the March rise in order to try to start to tame inflation. So I don't know whether that's going to do it or not. We'll see. But you know who the biggest debt holder is right now? It's the United States of America. So it's kind of like kicking your own butt a little bit. But we'll see what happens here. But this will be the one thing that I think could negatively affect us down the road is the cost of money is going to be higher at the end of the year than it is now. So looking at the soybean market, we did get a crop report about 10 days ago, or supply-demand report. USDA made one change in the U.S. balance sheet. That was raising the crush estimate by 25 million bushels to 2.215 billion bushels. That's a record domestic crush. The demand is very, very strong right now domestically for soybean meal. Back in January, their final production number was a record, 4.435 billion bushels of beans. Doesn't it seem incredible that we had a record bean crop and bean price of $16 a bushel? How does that work? It still befuddles me some days to try to step back and figure out why the markets are doing what they're doing. Ending stocks forecasted at 325 million bushels, which is snug, but it's not tight. We will have enough beans to get through the year. The unknown, I think, as we go forward is going to be this export number. 2.05 billion. USDA has not changed that number in the last 3 reports. I think a lot of us have been thinking that number would get smaller because of the China buying pace being down. But USDA has refused to change that so far. Now, there's people thinking that's doable because of the drought in South America, that maybe that'll shift some demand back to the U.S. So we'll see. There's a lot of moving parts, and I'll kind of show some of those. But South American production estimates have come down. AgRural, one of the analyst firms in Brazil, dropped their bean estimate this month to 128.5 million metric tons. Early on, the forecast was for 144 million tons. We were forecasting a record crop down there with bigger acres this year. Last year was the record at 137. So the crop was expected to grow, now we're expected to be down. CONAB, the Brazilian government, came out 2 weeks ago at 125.5 million tons. Saw this week somebody else came out about 122. So that crop continues to inch its way lower. Overall, Brazilian harvest is a third complete. Up in the northern states where the crop is excellent this year, they're well over 50% done. They've planted a lot of their double crop corn already. A lot of that corn's up and growing. Crops in that northern tier are doing really, really well. It's the southern tier where we've had some losses, and we're watching weather, especially down here into, well, let me go over this map. Rio Parana, Rio Grande do Sul, southern Brazil, over into Paraguay, eastern Argentina. This area is where we've had our losses this year. And so we continue to watch weather, although it's becoming less of a factor. It's kind of like late August down there now, so it's starting to get to where maybe it won't do as much good. But the latest 10-day forecast does show some helpful rains for this southern part of Brazil and across into Argentina. So that's not the factor in the market today, but certainly it's something to keep an eye on. So we'll see. Maybe we've stabilized the losses down there. We're probably down 20 to 25 million tons from what we expected to grow, probably about 15 to 20 million below last year's record high. So what happens to those bushels? I don't know if anybody heard the story last week. Some China Chinese diplomat made a statement that we could get by with 30 million tons less beans this year. They say they're finding alternative sources to feed other than soybean meal. So that may just be them spouting off, trying to get the market to go down. Probably didn't work very well, but a lot of moving pieces to this thing. The one thing that's very interesting is the early planting pace that the northern part of Brazil had this year. This, I think, is a fascinating map that we have this technology today to be able to take a satellite picture and be able to show where vessels are that are tagged that shipped out of Brazil. That's what this is showing. So when a vessel loads, I don't know how they tag the boat, but somehow they put a tag on it that can be read by a satellite. And at any point in time, they can take a snapshot and show where all these vessels are at. So you've got this big group of loaded boats that are on their way to China. You've got another group of vessels on their way to Southern Europe. Go back to last year, the same week, this is about 2 weeks ago now, the same week a year ago, they were barely loading any beans. So they're way ahead of normal pace this year. And I think that makes a lot of sense, A, because they planted early, and B, you got $16 beans. You got a big inverted market right now. They're going to take advantage of that the best they can and ship as many beans as quickly as they can. So I just, again, find this very fascinating that we have this technology. We can do this with U.S. soybean boats as well. So I'll go back to what we've loaded in exports and where we're going to be this year. Here's a snapshot of bean export inspections on a weekly basis this marketing year. We will get a report out at 11 o'clock this morning showing what last week's loadings were. But we're at the point in the year where we typically see exports start to go down. And that's because we start to shift to Southern Hemisphere. This year it started a little quicker than normal. And that was partly because of the early planting down there. And because, quite frankly, if you're an end user on the other side of the globe, do you want to ship beans today, or do you want to try to hold off as long as possible when next year's crop, new crop beans, are $1.50, $2 cheaper? That's what's starting to happen. China's been buying beans the last 2 weeks, but have you heard that most of those have been for the 22-23 marketing year? They're buying the cheaper beans, they're not buying the nearby beans. So they're going to try to be hand to mouth as much as possible. And, Brazil's meeting their export commitments, but I don't expect China to be any big buyers here in the old crop. So we are losing a little bit of export demand on the back end, and we lost some on the front end of the marketing year this year as well. We had Hurricane Ida hit the Gulf of Mexico back in September 1st, and that shut the Gulf down for 3 weeks. And so we weren't able to load any vessels other than off the Pacific West Coast, and therefore we were behind getting started in the year. We did catch up. October, November were big months, but you can see we got into late December, January, things have tailed off. Now, we would expect Brazil's going to really take over the export market for the next 4, 5, 6 months. But now there's starting to be speculation that Brazil may run out of beans by July. And so the trade is trying to figure out, well, will that bring export demand back to the U.S. late this summer? So again, there's a lot of moving pieces to this bean market right now. I think right now the market recognizes its job is to try to ration demand, try to cut some usage, and that's why the market's rallied the way it has. So, give credit to the funds, these managed funds I mentioned earlier. Here's what they've done in the bean market. The black line is this, goes back to July and going on into this year. And as of last week, they are long about 170,000 contracts of soybeans. That's the most they've ever held on this date. Last summer, we rewind, they were long about 100,000 contracts in July and August, and sold off most of that going into fall. Because we were harvesting a record bean crop, we had big plantings in Brazil that were happening at a fast pace. Funds decided it was time to get out of the bean market. Then we got into the weather situation in Brazil. Funds started to become big buyers in December and have continued their buying spree all the way into today. They're holding the biggest long position they've held on this date. The record that they held was back in the fall of 2020. They were long about 240,000 contracts. So if you look back to that year, they still have some buying power left. But I would still suggest that going down the road, that the biggest risk we've got in beans is if these people, if and when they decide to turn sellers, it can be a little painful. So kind of travel with caution in the market. If you got old crop beans, hallelujah, good for you. I would have probably gotten rid of mine a while back, but just take it, take a mental picture of this line and then transfer that into this chart. The funds have really been what the mover in this bean market. They sold the market down into fall. They rallied it sharply here recently. If you look at the technical indicators, the RSI, Relative Strength Index, and stochastics lines, both indicated this market was ripe for a sell-off. It was ready for a correction for about 2 weeks, the beginning of this month. Finally happened last week, and that was probably healthy for the market. We can't just keep going up and up and up. We needed to step back. The market did. We did not even trade down to the 20-day moving average, the blue line, before we were able to stop the sell-off and trade higher into the end of the week, and trade higher again this morning. Didn't quite make a new high in the March contract this morning, but it's pretty close. So again, the RSI is back above 70 today. Usually that's a sell signal, or at least it's a travel with caution signal as we go forward. If I had any old beans, I wish I did. I'd have gotten rid of mine a couple bucks ago. But if I do, I would probably suggest a minimum price sale. Sell your beans and go replace them with a call option. Go buy an out of the money option. Maybe you buy an $18 May call just in case this market keeps going up. Maybe you spend 20 cents, 25 cents on a call. In this market, I don't think 20 cents is much money. You can make or lose that overnight pretty quick. And so I think that's a good way to attack this market. I've been suggesting that for well over a year, this minimum price type strategy. To me, when we're in profitable situations where I can afford to spend a little money, I think that's a good way to market. For those that sold beans at 13 or so, that was really the level I was looking, 13 to 14. And at that time, I was suggesting sell beans and buy an out of the money call. And if you sold your beans at 14 and you bought a $16 call, that call's making money now. So to me, that's a good way to attack this market. Cash out, take your cash, but stay in the market with paper via a call option. The corn market, USDA did not make any changes to the balance sheet this month. Still forecasted, by the way, the crop this year was the second biggest ever at 15.115 billion bushels. Demand is still very strong, and ending stocks are forecasted at 1.54 billion bushels. Now, the way I look at this balance sheet, I look at 1.5 billion as somewhat of a tenuous number. That I think the job of the market is we're going to have to try to keep acres as close to 93 million as possible. And I think the trade knows this. I think that funds know this. And I think that's what's triggered a lot of the buying that started back in the fall. Now, I just added this chart this morning because of the situation in Ukraine. I wanted to know, I had to look up, what does Ukraine mean to the corn market? This year, they had a really good corn crop, and they're expected to be very strong competition with us, especially going to China. And we have seen Chinese buying a U.S. corn back off this year with the intent that we would see a lot of corn from Russia and Ukraine work that direction. Ukraine is the number 4 exporter of corn in the world. They account for about 12% of world exports. Russia accounts for about 1.5%. So keep an eye on the situation in the Ukraine and the port facilities over there. What happens if we shut the ports down? I don't have wheat in here. Between Russia and Ukraine and wheat, they account for about 1/3 of the world wheat export business. So you can understand why when we start talking about troop movements and shells being fired, why the wheat market and the corn market have gotten a little excited. And this morning, the oil market, because of the shutdown, because Germany announced it's shutting down the Nord Stream pipeline, so they got the energy sector fired up, the bean oil market's fired up this morning, so it's all kind of interconnected here. A lot of politics here this morning. But the funds in corn, funds are long about 370,000 contracts of corn. And again, I think going forward, this is probably our biggest risk, is that when and if these people decide it's time to sell, we could have some pressure. Now, I don't think that's likely to happen ahead of planting time. I think that the reason they built this long position was to make sure that we got the acres planted, to provide incentive to the market. And so, but you look at history, their biggest long position ever happened twice. Last year, they were long 400,000 contracts in the spring before they started to sell. 2012 was the other time they were long 400,000 contracts. And that was right in the heart of the drought. So right now we don't have much of a drought going on the way it looks out the door. But nonetheless, they're still holding a very, very large long position. So looking at March corn, if you got any old crop corn, I think it's a good opportunity as well here. We're trading up, we did a new high this morning at 671 3/4. What's interesting about this rally is if you look at the technical indicators, the RSI really hasn't been above 70 and really hasn't moved into what I would call overbought status. And so it's been a nice, slow, steady rally in the corn market. We're not used to seeing those. You know, I really don't think we like it when we blow off real high real quick, because oftentimes it comes down quicker in those type of markets. This has been a nice, steady rally. We've had good demand. We haven't had great demand. The ethanol sector started to slow down a little bit. Production's backing off. Ethanol stocks are rising. So there's, you know, that's a little bit troubling. But we really haven't focused much on demand. Corn's just trying to keep pace in order to keep acres for this year. If I had corn to sell, I would consider selling corn and buying maybe you buy a 7 something or an $8 May call, just in case this market keeps going. If it doesn't, I've got a heck of a floor here on my old crop corn. So looking ahead to 2022, I saw this survey a couple of weeks ago from Farm Progress. They were asking producers what factor most influences your corn choice at planting. And this year, the 64% said, we don't change, we stick with our rotation. I would have guessed most years that number's probably 80%, maybe even higher. This year, maybe a little different. 15% said the price of the commodity, 21% said the cost of inputs. So we do know input prices are going to be a factor in acres this year. I would imagine last year that number was probably down below 5%. But this year, that's been the story, I think, is the cost of nitrogen, cost of inputs on the farm. So I think we're going to be a little bit price sensitive going into spring. I live over in Illinois, and I don't know what you're all seeing locally here, but I've seen more land change hands this winter than I can ever remember. I get an auction book from one of my local auctioneer. It comes in November. And normally when I open that up, it's about 3/4 machinery auctions in the winter and about 1/4 land. This year was flip-flop. About 3/4 of the book was land auctions, about 1/4 of it was machinery. So I think there's some people taking advantage of the market, land certainly, and probably removed landowners that are selling some farm ground. But the point is that I think those acres are likely to be the ones that can shift. You know, if you didn't work the ground in the fall, you probably are still open to what you plan on, more than likely. So I think since we have more of that this year, maybe there's more land that's a little bit more sensitive to price. So I'm really focusing on this bean-corn ratio. You know, you look at the November bean, December corn spread. If you go back to September, when that ratio was 2.5 to 1, there were a lot of people talking huge bean acres getting planted this year. Then you fast forward 2 or 3 months to the end of November, and all of a sudden when that ratio went to 2.2 to 1, I know University of Illinois, Purdue, we're all talking bigger corn acres because of even with the math, even with higher input costs, corn was penciling out better than beans at that point. Now what's happened? We've gone the other direction. Now we're 2.45 to 1 again. So I don't know what's going to happen. I don't think the trade knows what's going to happen with some of these fringe acres. But how many, you know, if 10% of our acres were undecided, and we plant 180 million acres of corn and beans combined each year, that's 18 million acres. That's a huge amount that still could potentially swing. So I don't know if it's 10%, but the point is that there's still going to be some work to be done by the market to determine acres all the way up till planting time. We have had a few estimates out. By the way, this Thursday, the Ag Outlook Forum will convene via Zoom. It's not going to be live, but they're in Washington, D.C., and they will release their first estimates for the 2020 and the next 10 years, actually. They put out 10-year baseline numbers. Most people are going to be looking at the 2022 numbers. These are economist numbers. They're not based on surveys, but the trade will be looking to see what they have to say. These are some of the other numbers we've had in the last few months. Go back to last year, we planted 93.4 million acres of corn, 87.2 million acres of soybeans. Back in October, USDA economists put out numbers at 92 million corn, 87.5 million soybeans. 2 months later, FarmDoc, when the corn-bean ratio tightened, FarmDoc came out at 96 million corn, 85.5 million soybeans. They were thinking we could plant a lot of corn at that point. Then you get into February, Ihs Market, which used to be Informa Commodities, they came out at 91.5 million corn, 87.8 beans. ADM came out at 93 million corn and 87 beans. But then a few days later, Farm Futures had a survey that they released. They were all the way down to 90.4 million corn and 92.4 million beans. If that were to happen, it would be the third time in history that bean acres would top corn. I think one was in 2014, if I'm not mistaken. The other was 1983, the pick year. So we had the big set aside. So throw that out. We've only really had 1 year where beans top corn acres. But what I think is fascinating, within a 2-month window, you've got a range here in corn guesses at 5.5 million, and you got a range in beans of almost 7 million acres. That really tells me a lot of people don't know what's going to happen this spring. Probably more uncertainty than we've had in a long, long time. I would guess that the truth probably lies somewhere in the middle. My guess is that corn acres will be down slightly, bean acres will be up slightly. But again, we've got a ways to go till we get to planting time. We'll see what the market does. We'll see what input costs do, availability, all that good stuff. So ignore the lines on this chart for just a minute. November beans had a really flat, tight trading range late summer into fall. And then all of a sudden, when we had the Brazilian drought market take off, the November contract followed along, and now we've traded up over $14.70 a bushel here this morning. I think this is a great marketing opportunity. I told a group yesterday, I said, remember the years where I'm from Illinois, and everybody in Illinois used to root for a drought in Iowa. Everybody in Iowa used to root for a drought in Illinois. That's how we got the market to go up. Now it's the U.S. rooting for a drought in Brazil, right? So it's kind of like us against them at this point. And that's what's happened. We've got a weather market giving us a great opportunity without even having a crop in the ground. And so I think it's a great chance to get some beans locked in. I've been suggesting a third sold. If that makes you uncomfortable, go buy an out-of-the-money call option to help protect the sales. I've talked to some people that are half sold on beans. I would never talk you out of that. Guys are telling me, look, I put the pencil to paper. I know what my profit margin is. I know what my expenses are this year. I'm locking it up. And I think it's the best opportunity we've had in a long, long time to do something like that. Same with corn. The corn rally started back in the fall. And again, I attribute that to the rise in fertilizer prices. I think when the nitrogen market started to really take off, corn started along with it. That was the first leg of this rally. The second leg has been the bean rally. With the bean price going up, corn has had to try to go along to keep up and try to keep acres for this year. So again, I think a great opportunity to lock in good margins this year. Depending on when you bought your fertilizer, certainly that's going to be a factor. But at $6, are we kidding? Or who are we kidding? You know, it was 2012, the heat of the drought, the last time we saw a December corn trade $6. Isn't that amazing? And so, again, I think a great marketing opportunity. I've been suggesting selling a third. And again, if you're uncomfortable, go buy out-of-the-money call options. Talked to two producers in southeast Missouri a few weeks ago. They told me they were 70% hedged on new crop corn. And they said, look, we know what our costs are. We bought all of our inputs. We know what our margin looks like. It's going to be the best year we've ever had farming. We're locking it up. They're 70% sold. They're planning to buy the top end coverage on crop insurance that's going to get them up to 95% this year to be able to protect those bushels. They were actually hoping the market would go down so they could buy call options cheaper to cover their sales. But they had a plan in place. And this year, if you know what your costs are, you know what your margin looks like, you're going to have, I think, the best opportunity we've had in a long, long time, maybe ever for some. So I know Nathan's going to talk about crop insurance in a little bit. I'm a marketing guy at heart. I like to look at crop insurance from a price perspective. The half of the revenue formula is price times bushels. So we don't know what bushels are going to do this year, but I do know where price is. And if you go back to the charts I showed you at the beginning, we've got crop insurance starting average right now at $586. That number's probably going to be $590 or so when it's all said and done. So again, the best opportunity we've had since 2011. Soybeans, $14.26 through Friday. When we're set by next Monday, we're going to be probably above $14.30 on that number. Easily a record high bean price here for this year. So I think we can utilize this insurance program a little differently than we've done the last few years. in being able to lock in some revenue for this year. One of the products I'm most excited about was a new product last year called Enhanced Coverage Option, or ECO. ECO came out last year. ECO allows you to lock in a band of coverage from 86 to 90 or 86 to 95%. This is a county-based product, so keep that in mind. But it's cheaper because it's a county-based product. If you had to do it on your own, it would be a lot more expensive up at that top end. But the way ECO and SCO, its predecessor, work is you have your individual coverage down here in the blue. That's your individual protection, your revenue protection on your farm. SCO would provide that next level, which would go from your level up to 86%. If I'm at 85% already, I'm probably not going to mess with SCO for 1 point of protection. But the ECO allows me to get a band from 86 to 90 or 86 to 95%. So I look at this as a way to cover that shallow loss. And if I'm thinking this year the price could drop 50 cents, a buck, then maybe this is a way to protect that. If I'm not going to go out and forward sell 80, 90% of my expected production, how do I protect those bushels at the top on price? To me, this is a tool to be able to do that. So if I go back and look at the December corn chart I showed you a minute ago, let's start out, let's say that we end up with a base price of $5.85. I think it's going to be higher than that. But if we start at $5.85, let's say I buy an 80% RP policy. And let's say going into the year that we're going to have an average crop. We're just assuming my yields on my farm are going to be average this year, right at my APH. Then with an 80% revenue policy, essentially with an average yield, I have to have a drop in price to trigger a loss, which means I would have to have a 20% drop. I would have a price trigger at $4.68 a bushel. It essentially works as a put option if we have an average yield. If I bump my protection to 85, that number gets up close to $5. If I go up to 90% with ECO, now my trigger's up around 5.25, and at 95%, it's over $5.50 if the county has an average yield, as expected. So to me, I'm looking at these products kind of like a put option. And so what's my cost structure? What's my goal with crop insurance this year? Is to do what I've always done, to lock in part of my costs, all of my costs. Is it to try to lock in a revenue, a margin this year? And again, we haven't had that opportunity since probably 2013. This year, I think we can do that with some of these policies. So I got one example I want to look at on ECO. You can buy your individual protection. It's going to protect you on your farm at whatever level you want. I'm looking at this 86 to 95 band of protection at the top. And so we've got an indemnity worksheet to be able to walk you through the math on this. If I assume that the county yield is going to be unchanged from spring to fall, and I'm just looking at a drop in price, I'm starting at $5.85, and I'm going to say the price goes to $5 in the fall, which, by the way, $5 corn would still be a good number, but it's still down 85 cents. And I'm looking at this 9% band of coverage from 95 down to 86. The value of that 9% band we calculate using your APH. That's one of the nice things about these products. Even though they're county-based products, your APH is used to determine the value of that 9%. We take your APH up here, which I said was 190, times the higher of these two prices, 585, gives me my crop value at $1,112 an acre. You know, stop and think for a minute. We got a crop this year worth $1,100 an acre. That's pretty sobering. 2 years ago we were 800 maybe in some cases. So, you know, this is a heck of an opportunity. Take that number times 9%, gives me my dollars of protection, right at $100. That 9% band is worth $100. If we lose that entire 9% band of revenue, we get a check for $100. At the end of the year, I said that the yield didn't change, but the price went from $5.85 to $5. We ended up achieving basically 86% of our expected revenue, which is below our trigger of 95 by 9%. Essentially, we end up collecting that entire band at $5 corn. I backed into it. Actually, at $5.03 corn, we would collect that entire $100 an acre, just because of the drop in the price. This doesn't take into account any change in bushels this year. So if I think that there's a good chance of price coming down, maybe this is a good marketing tool as well as a bushel tool. And because it's a 95% trigger, anything that causes a 5% loss in the county revenue is going to trigger a loss. So I can look at our matrix and it shows me that
You know, here's our starting yield. We got yields across the top. We got prices on the left-hand side. We get a 5% drop in bushels this way. We start to trigger 5% loss of revenue. We start to trigger. You can also see down, well, let me go around the matrix real quick. We could have a good yield. Let's say we end up with 181 county yield in Johnson County. That's 9 bushel better than the expected number. At 527, we're starting to trigger payments already. Price doesn't have to go down that far, even with a great yield in the county, to start to trigger a payment. If we get down very far on this matrix, you can see we're getting the entire $100. And at that point, that's where your individual protection starts to kick in. If the price goes down further or bushels start to get lost, that's why you've got your individual coverage to protect you below that. If we're in a situation like a 2012, where we have a drought and market rallies, let's say we end up with a county yield at 133, market goes up over $2, our payment goes up from $100 to $135. And that's because this yellow box right here, the harvest price, we get to use that harvest price to recalculate our dollars of coverage, and this number goes to 130, or what was the number, 135. So in the worst case scenario where we have another drought, then we're protected to the upside as well. I had a gentleman ask me in a meeting last week, what about these white boxes? What happens over here? My comment was, you've had the best revenue year raising corn you've ever had, most likely, because we did not even have a 5% drop in revenue from where we're starting at. So to me, that's what you want to have happen. You know, you would like to buy this policy and not collect on it, have prices still in the 5s and 6s, and have yields up close to or above the expected county yield. So that's what we want to have happen. But the opportunity this year with prices high, I think it's too good to pass up. Also, NAU country within our quoter, our historical tab, we can go back and look at other years. If we would have had ECO and SCO, what would they have done? What would they have looked like? And this is for Johnson County corn, and you can see the last 5 years we wouldn't have had any payments. But we know where starting prices were the last 5 years, and we know we had pretty good yields. But you go back to some of these high price years, 2008, 2011. Of course, 12 was a drought year when the market went higher. 13 and 14 we started out with high prices, and we would have had ECO payments, what, 1, 2, 3, 6 straight, and 8 out of 9 years, mostly because of drop in price. Now here we are this year, starting with high prices once again. So we'll see what happens. But again, I think this is at least a product you need to at least take a look at here this year. Same with beans. I'm not going to go through the math, but if I show you on the chart, you know, an 80% RP policy with an average yield gives me price protection at 1136. I could bump that to 85, 90, or 95%. And then again, it really boils down to what do I want to use my crop insurance for this year? Am I just using it to cover part of my expenses? Am I going to try to cover all my expenses? Or am I going to try to lock in a profit margin? And I think that's something you got to decide on your own. Everybody's going to be different, but we've got some good opportunities this year. One last tool that I do want to mention because it's related to marketing is forward contract insurance protection. FCIP is an NAU product, and it's designed for producers that want to be aggressive forward sellers. If you view yourself that way, that I want to be an aggressive seller this year, maybe consider using this. It's essentially a policy that protects your bushels that you've sold to the elevator. So you can buy that for 50 to 70% coverage based on your APH. And if this year's the year I say I'm going to go out and sell 50% or 60% of my APH ahead of time and lock it in. But my fear is that if something happens like prevented plant and I can't deliver the bushels to the elevator, this is going to pay to cover the cost of canceling those remaining contracts. So if you're interested, look us up, talk to us, we can talk to you about it. We haven't written much of this in the past, quite frankly, because there was no reason to go out and forward sell a lot of grain at $3.88 corn 2 years ago or whatever. This year with prices high, it's gotten a lot more interest, so I did want to mention it to the group. So now, through February 28th, we are setting our base prices. That was yesterday. We had the markets closed for President's Day. March 9th, we get our next USDA report. I'm really going to be looking at that bean export number in there. What's the government thinking on soybean exports? The day after every one of our USDA reports, I host a webinar called the NAU Country Aftermath. It starts at 10 a.m. your time. We talk about the previous day's report, what the aftermath of the report was, the impact on markets, crop insurance, government programs, basically a lot of the same stuff we did here today. If you don't want to tune in live, it's recorded. We posted it on our YouTube page. You can go out there and check them out, type in NAU Country, and go view those. March 15 is our deadline, both for crop insurance and at the FSA office, with your ARC PLC election this year. And then lastly, the biggest report we'll have this spring will be on March 31st. That's a prospective plannings report. That's when the government puts out their first official set of acreage numbers based on surveys that they're going to take here in the middle of March. So maybe some of you in the room will get a survey, we'll see. But that'll be a big day for the report, for the market. Also, we get a grain stocks report that day as well. So a lot of numbers to look at on the 31st. And for those that are not familiar, we do have some services available through NAU Country, marketing-wise. There's some cards over on the table. You can grab on the green cards. But I do an opening bell phone call every morning. It comes out about, I record it about 9:35, 5 minutes after the day session opens, and it comes to you a couple of minutes later with an update on the markets, why they're doing what they're doing, and what they did. It's about a 2-minute phone blast. If you're interested, put your name, phone number on a piece of paper, give it to Danny, Nathan, one of us, we can get you hooked up. The market report is an email letter I do in the afternoon or evening. Again, we update on the markets, crop insurance prices, you name it. So if you're interested in that, give us your email address, we can add you to the list. I mentioned the Aftermath webinar that we do once a month. I do a podcast occasionally called Kicking Up Dust. It's on Podbean, so if any of you are interested in podcasts, you can go check that out. I also usually tweet on the markets during the morning break with how the market did in the overnight session. So if you want to follow me on Twitter, you're welcome to do that as well. But the point is, we got a lot of different ways to get information out to you to help you make decisions. This is crop insurance month, I realize that, but the other 11 months of the year, we're focused on helping you use that policy to be profitable. And we want to help you try to make money. So let us know if we can help you with any of these services. So any questions or comments?
When's the ECO determined?
The final county yields come out in the following spring.
When is the payment yet?
The payment would be made probably in June. So it's going to be about 6 months after harvest. Probably one of the negatives about it. And all the county policies are like that now. So.
With the oil prices, with what Putin's doing, did you talk about the upside of buying that call? Did you not talk about that enough? Because if your soybean price is going like this, right, with oil,
Yeah?
you would think that what Putin's doing is going to force the price of oil, and it's going to slow down the rest of the economy, because when you hit $4 at the pump, inflation goes away, because that's the biggest tax on our population. But that call would be a good idea.
It's not a bad. When you've got profit margin already in it, spending 20 cents, give or take, I don't think it's a lot of money to spend. At $3.80 corn or $9 beans, I wouldn't have wanted to go spend 15, 20 cents. At $16, you know, if you go out to 18 or 19 bucks to buy it, to spend what you want to spend, it's probably a good money to spend.
That's what I was sitting there watching the graphs. That's what I was thinking.
Yep. So. Oh, yeah. Oh, well, guys, thanks a bunch.